Students, we are going to, I am Ashok Kumar Aggarwal, Academic Counselor, IGNOU. We are going to discuss Block 3, Financing Decisions. Now, in this particular unit, we are going to, study whether to finance or not. Suppose any application comes to the bank. Now, bank processes the application. If bank finds that it is, economically viable, unit is going to work and unit is going to earn profit and technically feasible, then bank goes ahead and bank sanctions that loan. The first chapter in this particular session is financial markets, that is unit 8. A financial market is essentially a platform where financial assets are traded between various participants. These markets are crucial for the proper allocation of resources in an economy. For example, now if somebody is studying in USA and his father every month buys dollars, students, I am Ashok Kumar Aggarwal, Academic Counselor at IGNOU. We are going to study today Block 3, Financing Decisions. We are going to discuss Unit 8, Financial Markets. A financial market is essentially a platform where financial assets are traded between various participants. These markets are crucial for the proper allocation of resources in an economy. These markets operate under defined rules and regulations that guide the process of financial transactions and ensure transparency and security for all participants involved. The channeling of funds promotes economic efficiency and productivity by ensuring that capital is used where it is most needed. These markets facilitate trading in financial assets. Financial markets perform several critical functions that contribute to a nation's development. One of their core roles is the efficient transfer of funds from surplus units to deficit units. Now, for example, Mr. A is having surplus funds and Mr. B is in need of funds. A will not trust B and A will not lend money to B. But if A deposits his funds in a bank and B requests the bank for giving a loan, and if B falls under the criteria of the bank as per rules of the bank, if his application is, so bank will sanction the loan to B. The funds which A has deposited in the bank, that will fetch him interest. Banks investing money is in the bank is very safe. Suppose you invest 1 lakh rupees in share market today, tomorrow it will become 90,000. You may not get back your principal, but once if you invest in the bank, your principal will be intact. Your principal will remain 1 lakh only, plus bank will give you interest. Of course, bank gives you little less interest compared to, you see, at other places you can earn, you see, more interest elsewhere, but your funds are very much secured. The movement of funds in the economy can happen in two primary ways: directly through financial markets or indirectly through, you see, financial intermediaries like banks. You see, financial intermediaries are banks, NBFCs, non-banking financial companies. You see, what non-banking financial companies do? Non-banking financial companies can't have a saving, they can't open your saving bank account. You see, they can't send the checks of a depositor in clearing, they don't participate in the clearing, but there are NBFCs, they are allowed to accept deposits. They will give interest, say 0.25, 0.5% more than banks. There are NBFCs which give loans. For example, you see, so many NBFCs are there, they are giving loans for trucks, for, you see, vehicles, they are giving loans for business also, small scale industries also, they are giving loans. Economic functions of financial markets include the facilitation of resource allocation from those who save, who invest in productive activities. This leads to an increase in income and production. Financial function of financial markets involve providing investment opportunities to surplus units and enabling deficit units to obtain funds for their activities. These markets create liquidity by making finance, you see, easily tradable. Other important functions include price discovery, liquidity provision and reduction of transaction costs. Price discovery happens when the interaction of supply and demand in financial markets determine. Financial markets in India are categorized based on the instruments traded, duration of maturity and level of organization. Broadly, these are divided into organized markets regulated by the government agencies like Reserve Bank of India, you see, SEBI, then for insurance sector also IRDA, etc. The money market deals with short term financial instrument, you see, with maturities up to 1 year. Suppose one bank is needing money for 1 day, you see, it will borrow from another bank. It is a, or some, you see, they will need, some bank will need money for 14 days. It is a wholesale market for instruments that are near substitutes for money and can be easily converted to cash. In India, the money market consists of both organized and unorganized segments. You see, unorganized segments, say previously there used to be money lenders, you see, so those all come under, you see, unorganized sector. Organized markets include commercial banks, financial institutions and the Reserve Bank of India. Commercial banks, especially nationalized banks, you see, during Indira Gandhi's regime in 1969, 14 major banks were nationalized. Prior to that, they only used to entertain rich people. You see, banks were belonging to Tata, Birla, all rich people, and they used to only entertain rich people. But in 1969, you see, in the month of July, our then Prime Minister Indira Gandhi, she nationalized, you see, 14 major commercial banks like, you see, Bank of India, Central Bank of India, Union Bank of India, then Punjab National Bank, Oriental Bank of Commerce, New Bank of India, then Indian Overseas Bank, Indian Bank, then Allahabad Bank, United Commercial Bank, United Bank of India, then Syndicate Bank, Corporation Bank, etc. In all these banks, government purchased more than 50% of their shares, you see, so they became the government banks. After that, government you see appointed their you see chairman and managing director, CMD, and executive director. These two posts, these two higher posts in the banks were appointed by the government, Ministry of Finance, Banking Division. So all these banks, you see, government send the CMDs and they send the executive directors. Plus government, after nationalization, they have asked banks to open branches, go to the rural areas, go to semi-urban areas, you see, and increase the number of branches. You see, entire in the whole country, the districts were allocated to the, distributed to the banks. So those particular banks, suppose some districts is distributed to Allahabad Bank. Now Allahabad Bank is the lead bank in that district. Its main role was to find out, you see, where they can finance, what is the scope in that village. So which industry you see can do well in that industry. So they used to finance for those industries. And you see, today the position is that, you see, banking is available to the doors of the people in the entire country. You see, you will find, you see, everywhere commercial banks are there, they are having branches. And our Prime Minister, now our Prime Minister wants that everybody should have a bank account also. If suppose government wants to send some subsidy to any, you see, poor person, so it will straight away go to his bank account. Earlier government used to give subsidies, but it used to be eaten up by, you see, mediators. It never, hardly, very little amount was reaching the, you see, persons who, for whom it was, you see, sent. Major instruments in the money market today are, you see, treasury bills. Treasury bills are issued by, you see, Reserve Bank of India. Very, you see, secured, very secured security. You will, they are issued, suppose they are, one treasury bill is, you see, 1 lakh rupees, and they write in that its redeemable value is 1 lakh, and today they will be selling it at 80,000 rupees or 90,000 or 70,000 rupees. On the treasury bill, only redeemable value is written. So today they will charge you, suppose they are selling it for 70,000. So you will have a interest component of 30,000 in this. And then there is, you see, commercial paper, certificate of deposit. You see, these are issued by the banks, and these are issued by high corporates. Like, you see, if suppose Reliance wants to, you see, collect money from the people, they will issue these certificates, and they give good interest. Similarly, commercial banks also, if suppose they are in need of money, they will issue these certificates and give higher rate of interest. And then next is call and notice money. Suppose just now we studied, some bank wants, you see, money for 1 day. So it will go to some another commercial bank and borrow the money for 1 day or 2 days. The money market is essential for maintaining equilibrium between short term fund supply and demand. You see, for short period, if suppose somebody is needing the money, so it will take care of that. It enables the RBI to influence liquidity in the economy and provides participants with efficient, you see, avenues. Capital markets, you see, deal now capital market, primary market and secondary market. Suppose, you see, some Reliance has started some new, you see, business. Now it will issue shares, it will collect money from the, you see, people. So first will be, you see, application money, then allotment money, then first call money, then second call and final call money, you see. So those shares, you see, which are new, they are dealt in the primary market, and once, if you see, they become little old, then you can, you see, buy in the secondary market those shares. You can sell those shares in the, you see, secondary market. Now compared to earlier, things are, you see, very easy. You can buy, if you want to buy, in no time your account will be debited, and in your, you see, share account, shares will come. And if you want to sell, you see, from your shares account, those shares will, you see, they will show you see the balance will be reduced and money will come in your, you see, account. It is very easy to buy and sell the shares now. The capital market is divided into just now we studied, you see, primary market and the secondary market. When a new share is issued, it is sold in the primary market. We took the example of Reliance. First they will give advertisement in the newspaper, then people will deposit application money along with the application in some bank, then those people are, you see, allotted shares. Now suppose Reliance wants to collect 1 crore, say 10 lakh shares of 10 rupees each they want to send. If it is oversubscribed, say 20 lakh applications they have received, so then they will do allotment like, you see, if suppose somebody has applied for 100 shares, they will give him 50 shares, like this they will, you see, allot. Then after that they will collect allotment money, then first application money, the second application, second call money, first call money, and these are done in primary market. And once, you see, shares are little old, then they will be sold and they will be purchased in the secondary market. The primary market is where new securities are issued, often through initial public offerings, IPOs, and the secondary market is where these securities are traded after their initial issuance. You see, after their initial issuance, if anybody wants to buy, he can buy it in the secondary market. Anybody wants to sell, he can sell in the secondary market. Functions of the capital market include efficient capital allocation. You see, by selling these shares, you see, company has collected the money and now it can start, you see, it can go ahead with production. You see, first it will take the, you see, factory premises, suppose either its own or it is rented. Then similarly, simultaneously it will complete the formalities of registrar of companies, ROC also, you see, and then production it will start, you see, production. Then risk capital provision, price discovery and increased investor participation, you see. These markets also help in disseminating information. Equity markets, you see, equity markets are platforms for trading shares that represent ownership in companies, you see. Equity means, you see, the own stake of the company. Suppose, you see, a company applies for a loan to a financial institution, that financial institution sees that what is your stake in the business. Normally, suppose, you see, they will see if, you see, outside borrowings are the ratio of outside borrowings and equity. If it is 2:1, if it is 3:1, it is all right, it is okay. Companies, you see, will do well and company will be in a position to repay its debts. But if this ratio is, you see, say 6:1, 7:1, this means company itself is investing very, company itself is having very little, you see, money. It is mainly depending on the money of, you see, outsiders. Equity markets help companies raise funds for business expansion and allow investors to gain ownership stakes and, you see, potential dividends. You see, when you invest in a company, first thing is your share value. If the company is doing well, the value of your share will also increase. Plus, you see, it will fetch you good dividend. You see, every year company declares the dividend, good percentage you will get, you see, good dividend. Both ways, you see, you are benefited provided the company is doing well. If the company is doing well. Now, debt markets. Debt markets involve the issuance and trading of fixed income securities such as bonds and debentures. Here in the beginning, when you invest, you see, they will tell you, we will give you 10% interest. You want quarterly, we can give you quarterly, half yearly, you see, yearly, every year, same. And at the end, you see, suppose it is for 5 years, you see, at the end they will give you back your principal. The Indian debt markets consist of several, you see, segments. Government securities, you see, risk free instruments issued by RBI, you see, highly secured, you see, nobody will lose money if they buy, you see, these securities, and they are always available. Suppose it is mentioned 1 lakh rupees maturity value of government security. Today if you want to buy, they will, you see, sell you for 70,000 or 80,000. They are always, you see, sold at discount. Then corporate bonds means, you see, companies, you see, good companies, they issue funds by, you see, they raise funds by issuing corporate bonds. Then again debentures, fixed interest, you see, just now we discussed, say 10%, 12%, you see, they will collect, company will collect money by issuing the debentures, and every year company will pay the interest to the investor. Then bonds, you see, including zero coupon bonds also. Next is derivatives, you see, market. Derivative market trade financial instruments whose value is derived from an underlying asset such as stocks, commodities, or, you see, currencies. These instruments include forwards, futures, options, swaps. Now, if any asset, its value is dependent on another asset, you see, initially traded in over the counter markets, derivatives are now increasingly traded on organized exchange that offer standardization, transparency, and reduce counterparty risk. Next is commodities market. The commodities market facilitates the trading of physical goods such as, you see, agriculture products, metals, and energy products. These markets help producers and consumers hedge against, you see, price volatility. Next is foreign exchange market. You see, we took the example, suppose, you see, you want to send money to your son who is studying in USA, dollars, you see, every month you are selling, you see, you have to buy foreign exchange from any commercial bank or any, you see, foreign exchange dealer who sells, you see, these. The foreign exchange, forex market deals with the trading of currencies. You give rupee, he will give you dollars. It is regulated by the Reserve Bank of India. In our country, it is regulated by the Reserve Bank of India and provides, you see, guidelines for transactions. Forex markets are crucial for international trade. You see, suppose you are doing exports, you are doing imports. If you are doing exports, then, you see, suppose you have got a order of 10,000, you see, shirts, USA, your buyer is in USA. The first thing which he will send you is, his bank will send you a letter of credit, LC. In this letter of credit, you see, it is mentioned that if your order is as per the requirement and the importer, we take the guarantee of the payment, you see, you don't worry about that, you see, because importer is having account in that bank. Similarly, exporter is having account in India. So exporter can borrow money also, you see, once he gets LC, he can borrow money also from the bank, and he will, you see, finish manufacturing these 10,000 shirts, and then he will, you see, send them by ship. He will send the assignment, he will submit all the papers from the to his bank will send all the papers to the importer's bank. So importer's bank will collect the money, you see, from the importer and send to the exporter's bank. How we trade in India, same way it is, you see, trade is done between one country and another. And like, if suppose you are sending goods to Bombay, so that Bombay, your buyer will send money through his bank to you. The cost of the sales, you see, proceeds. Similarly, it is done at international, you see, level also, from, you see, one country to another country. There this foreign currency is involved. The foreign exchange market deals with the trading of currencies. It is regulated by Reserve Bank of India and provides guidelines for transactions. Forex markets are crucial for international trade and investments. Derivative markets such as you see currency, futures, you see to hedge against you see currency fluctuations, it protects. Next is other markets are loan markets. You see banks and institutions provide short term and long term loans. You see normally if the repayment period is 3 years and less, that is short term you see loan. If it is demand loan also you can say, if it is for 7 years, 8 years, it is long term. Now housing loans are, now banks are giving in our country housing loans for 25 years, 30 years, even more than 30 years also you see they are giving. Then insurance market provides risk coverage and invest collected premiums in capital markets. Next is retirement savings markets, you see pension funds. Other markets are mutual funds. You see mutual funds allow small investors to assess professionally manage diversified you see portfolios. Now in mutual fund there is systematic investment plan also. Every month suppose you contribute. So now you are contributing in bank RD account every month 1000 rupees say. Say after 2 years it will fetch you, you see 24,000 your principal and 1 or 2,000 rupees interest. But sometimes in mutual fund if you invest you see 1000 rupees systematic investment scheme, and for after 2 years you see instead of 24,000 if you redeem they will give you 30,000 approximately. Sometimes not always you see. So there you can earn more because they are those people who get the money, they are professionals. They are having lot of experience where to invest the money and you see how to give you maximum return. So they invest the money in such companies where you see they are sure that it is going to make profit and it is going to give more interest to the you see investors. Now next is savings and investment markets. Offer retail products like fixed deposits and recurring deposits to you see households. Now savings, you can have a saving bank account in a bank, you can have you see fixed deposit. Then in fixed deposit interest can be serviced to you quarterly, monthly also. But if you don't want to interest, then you will earn interest over interest. So everything will be given to you at the time of you see maturity. Then there are you see 2-in-1 accounts in banks. In those accounts what they do, you see your suppose they say in your saving bank account we will keep you see 25,000 rupees and beyond that we will transfer to your fixed deposit accounts. So they make units of 1000 each. You see at any point of time 25,000 is there in your saving bank account and whatever is extra those units are transferred to your fixed deposit, 1000 rupees each unit. And whenever suppose you are needing the money in saving bank account, you see money will come from fixed deposit account to this account, money will come back you see from fixed deposit to this account. Those are now 2-in-1 you see accounts. Next is participants in financial markets. Participants in financial markets play a critical role in facilitating the smooth flow of you see funds from surplus to deficit sectors in the economy. These participants can be broadly categorized based on the segment, operate in the money market to capital market. The money market companies comprises you see institutions and individuals who engage in short term borrowing and lending. The participants operate based on varying you see interest rates, credit worthiness and maturities. The RBI is the apex monetary you see authority in India and the most influential participant in the money market. It regulates you see money supply, interest rates and liquidity in the economy. Each country is having a central bank. In our country the central bank is you see Reserve Bank of India. The central bank acts as the banker to the government you see. Commercial banks, you see, we already discussed, these are the most active players in the money market. They accept deposit, you see, for the purpose of, you see, lending. If they won't, you see, lend, then how they will earn interest? You see, they have to give interest to the depositors, plus the expenses of the bank, the expense, how a bank branch works. You see, bank branch, you see, is accepting deposits from the public, and then that particular branch is giving loans. In deposits, they pay little less interest compared to the interest they charge on loans. Besides this, they are having, you see, this safe deposit lockers. They keep your securities in the vaults also, they will keep your securities. Then, you see, they are you see, earning commission by means of check collection, etc. Other businesses, you see, they bills collection. Now, you see, commercial banks, they are selling third party products also. There are so many companies, say for example, health insurance. So many companies are, you see, insurance companies are there, they are having health insurance policies. Now banks, you see, what bank branch will do? Bank branch will, you see, keep this for health insurance, they will keep the insurance pamphlets, they will keep in one counter, normally at may I help you counter in a bank branch. And they give a, you see, they install a poster, they do some advertising for that. And people, whosoever, you see, account holders, they visit the branch for banking, you see, services. So they pick up that application, they fill that. And in fact, health insurance policy everybody should have. Suppose hospitalization is there, you fall sick and you see hospitalization is there, your hard earned money, 50,000, 1 lakh rupees will go. If you are having insurance policy, you see, these policies are, most of these policies are cashless. You have not to pay anything. You have to simply show your policy to the hospital, and they cover most of the hospitals, So everybody should have this health insurance, you see, policy, which commercial banks are selling. Many banks are having their own insurance companies. Those policies they are selling, like State Bank of India, they are having their own insurance. And many are not having their own insurance, you see, companies, so they are selling the insurance policies of other companies. They are known as third party products. Now what this insurance company, they give commission to the bank, and this commission straight away goes to the profit and loss of the bank. You see, it is going to the profit. So if suppose each commercial bank is having 5,000 branches in now these days in India, of each branch, you see, daily sells suppose 5 applications. So they are selling 25,000 applications daily of health insurance, and insurance company suppose pays, you see, 100 rupees, you see, per application. Now you can imagine, you see, how much money bank is earning as commission, and per day, and annual commission is, you see, a lot of money bank is earning like this, and bank has to do very little efforts, because bank is having customers, you see, account holders. Some branches are even 50 years old branches are there, very number of account holders are very large, and you see, they collect you see, commission like this, and insurance company representative will come in the evening, take all the applications received along with the check. Customer has only to enclose the check, plus at the most PAN number, Aadhaar card, you see. Similarly, banks have entered into this gold coins. They are selling gold coins also. In that they earn commission. Then banks are having, you see, these mutual funds banks are selling. They are having, you see, tie-up arrangements with mutual fund companies. Many, you see, banks are having their own mutual fund companies. Those who are not having their own mutual fund companies, they are selling mutual funds of other companies. Even those who are having their own mutual funds, still they are selling mutual funds of other companies also. You see, it depends on the buyer's, you see, choice, which mutual fund, you see, he wants to purchase. So it is good for the mutual fund and insurance companies also, because they are getting business like this. Otherwise they have to open their own offices, you see, and then lot of expenses. They are, you see, saving expenses and getting business through these commercial banks, and in return they are paying them commission. So this works out to be cheaper for them. So these all, then lockers, banks are earning, you see, through giving lockers on, you see, rent, then collection of, you see, dividend warrant. They collect, you see, checks for the customers, other services which commercial banks are doing. Next is indigenous, you see, financial agencies. These include money lenders, you see, and indigenous, you see, bankers, especially prominent in rural and semi-urban, you see, areas. Their operations are informal and mostly outside the regulatory framework. They don't come under regulatory framework. They are outside the regulatory, you see, frame. Then discount houses, you see, these institutions provide liquidity by discounting trade bills, you see. Now they will, if suppose you are having any bill, you have got it discounted, and on the date of maturity they will collect money. They play dual role, discounting bills for traders and rediscounting them for, you see, commercial banks. You see, commercial banks, those who have discounted the bills, they, you see, rediscount for commercial banks. Like that, liquidity is maintained. Then acceptance houses, through rare in India, acceptance houses exist in advanced economies. They accept bills drawn on them, provide trade financing and offer advisory services related to shipping, insurance and credit regulation. Participants in capital markets, you see, capital markets involve a larger and more diverse group of institutions. These participants may provide finance directly or offer services that support investment and, you see, trading in long term financial instruments. Commercial banks, you see, banking institutions, commercial banks, apart from their money market role, commercial banks are involved in long term lending in the capital market. Cooperative banks and land development banks, these banks cater to specific sectors such as agriculture and small scale industries. Non-banking financial institutions, NBFCs, investment banks, primarily functioning in developed economies like the USA. Investment banks help channel household savings into businesses. Merchant banks provide, you see, financial advisory services, especially to, you see, corporate clients. Their services include corporate counseling, project counseling, capital restructuring, issue management, portfolio management, credit, you see, syndication and working capital, you see, finance, corporate restructuring. Investment companies, these institutions pool funds from the public through instruments like units, shares and debentures and invest them in securities. They can be categorized as management investment companies, unit trust of India, you see, long back it started, it was the first to start. Then insurance companies with access to long term premium income, insurance companies invest in government securities and corporate bonds. Development banks established post-war II, these institutions finance industry and infrastructure projects. Pension funds, these funds collect long term contribution from employees and employers and invest them in capital markets. Private sector finance companies, these companies raise funds through shares, debentures and intercorporate deposits and lend them as short term, you see, business credit. Financial markets are indispensable to any economy as they facilitate the exchange of financial instruments and efficient allocation of resources. These markets bridge the gap between surplus and deficit, you see, units. Participants in these markets range from central banks, commercial banks and cooperative institutions to merchant banks, investment companies, mutual funds, insurance companies, development banks, pension funds and you see private finance firms. Efficient financial markets promote transparency, liquidity, price discovery and economic development. Now we come on financial services. Financial services constitute a critical component of the financial system. They encompass a broad range of activities like services offered by financial institutions and intermediaries that facilitate the flow of funds in the economy. In India, the financial service sector has undergone tremendous transformation since the 1990s due to liberalization, privatization and globalization. Financial services refer to economic services provided by the finance industry, which encompasses a wide range of business that manage money. These services include banking, insurance, investment, management, leasing, factoring, venture capital and more. The scope of financial services is vast and includes mobilization and allocation of savings, promotion of investment activities, facilitating credit flow and liquidity, management of risk and uncertainties, financial planning and advisory services. The main object of financial services is to ensure efficient and effective management of money. They serve the dual purpose of offering returns to savers and supply necessary funds to investors. Characteristics of financial services, intangibility. Financial services are abstract and cannot be physically touched or possessed. They represent a promise or potential benefit and are often delivered as contractual agreement between institution and clients. Then inseparability, then perishability, perishable goods. Suppose these fruits, they will destroy within 24 hours. So they are perishable commodities. Financial services cannot be stored. Next is heterogeneity. Financial services are highly customized depending on client needs, credit profits, risk appetite and objectives. Hence they vary from client to client. Customer participation. Then highly regulated. Customer participation. Financial services often require active involvement of customer. Classification of financial services. Financial services can be classified broadly into two categories: non-fund based services, fund based services and non-fund based financial services. Fund based services means you give loan, money. Non-fund based financial services like you have issued a guarantee, you have issued a letter of credit. Now guarantee means, suppose there is a project and you have issued a performance guarantee. Bank is issuing a performance guarantee on behalf of their client that this particular client will complete this project. So that is performance guarantee. Second type of guarantee is financial guarantee. Suppose some for example you have given a flat on rent. Now you are not sure whether tenant will give you rent every month or not. You will tell to the tenant that you go to your bank and ask the bank to issue a guarantee in my favor, in favor of landlord. So what bank will do? Bank will issue a guarantee in favor of landlord that if the tenant did not give the rent every month, we will pay you rent. So now landlord is sure that he will give the flat on rent to that particular tenant, because he knows that if he did not pay the rent, bank will pay me. So this is financial guarantee. Here bank is taking the responsibility of paying the money to the landlord. Now but why bank will issue You see, you should have an account in the bank. You should be old customer of the bank, then bank will issue on your behalf, and bank will ask you to invest money in the bank also. Bank will say you give us a fixed deposit, or suppose you are already having a fixed deposit. Say rent of the year is say 2 lakh rupees. You are already having a deposit of 3 lakh rupees in the bank. So bank knows that, you see, if I had to pay on his behalf rent, so his 3 lakhs deposit is there with me. So we will take it from that. We will, you see, bank keeps that deposit receipt with him and marks a lien on that. So like this, bank issues financial guarantees and bank issues performance guarantees. Now in this particular business, bank is not investing any money in the beginning. In the beginning, bank is not giving any money. Bank is only giving a paper signed by the bank that we guarantee this. So this performance guarantee may become financial later on. If suppose the client does not fulfill his promise, then bank will have to pay the money, and then in return bank will recover from his client. Bank can file a suit also, bank can file a court case also against the client if he doesn't, you see, pay the money. Similarly, bank issues, you see, letter of credit also. Letter of credit means, you see, bank takes the responsibility on behalf of the importer that if importer did not pay, we will pay. There are local LCs also, local letter of credit also, if suppose the purchaser, seller and purchaser both are in India. So bank can take guarantee on behalf of the purchaser that if he did not pay the money to the seller, then bank says we will pay you. So then, you see, that seller is confident that I will, you see, get money. So he fulfills that order. So there are two types of financial, you see, services. One we discussed, you see, where money is not parted away with the bank in the beginning, that is non-fund based, and second is fund based. Now fund based is bank will give loan for business, bank will give money, then bank gives, you see, housing loan, bank gives vehicle loan, bank gives, you see, consumer loan, bank is issuing credit cards also, then mortgage loan, reverse mortgage. Now one new type of loan has come, reverse mortgage loan. Suppose somebody is having property but he is not having regular income. Children, old couple is there, they are having property, children are also not looking after them. So what they will do, they will go to the bank, mortgage their house to the bank, and then bank will, you see, give them money. Bank will give them regularly, bank will pay them money every month. You see, after their death, you see, bank will sell that property and recover, close that loan account. This is the latest type of, you see, it is known as reverse mortgage, you see, loan. There are so many people, their children are not looking after them, but they are having property. So now Reserve Bank thought that why not to help, you see, people like this. So they help that old couple, and property is mortgaged. They will do the valuation of the property, they will mortgage the property, and then every month regularly they will give them money for their, you see, household expenses, whatever is their requirement. And once if husband dies, then wife, bank will continue to give money to the wife. After the death of the wife also, bank will sell that property and, you see, close the loan accounts. So now these services, you see, involve direct deployment of funds, you see, by the financial institutions, leasing, then hire purchase, then bill discounting. These are all the facilities, you see, given by the financial institutions. Then factoring, then venture capital, housing finance, just now we discussed. Now housing finance bank is giving for 30 years, 35 years also, because property has become very costly, and they will ask the customer to include his wife's name also. If his wife is earning, you see, both, bank will consider the salary of both the people, and then bank will sanction the loan. By this they can get more, the quantum of loan can be, you see, increased by this. Then next is, you see, non-fund based financial services are, you see, merchant banking, then credit rating, then stock, you see, broking, then custodian services, then mutual funds, insurance services, then portfolio management services. Now portfolio means, you know, suppose if you invest your entire money in one sector, suppose, and tomorrow you go in loss. So it is better to have investments in at various places. You invest in mutual fund, you invest in life insurance, you invest in bank, you invest in post office, you invest in share market. You see, share market you may make money also. You can, you see, sell the securities at more price like that. So this is your portfolio, mixed of investments. Never invest in one security. Then economic liberalization, you see, deregulation. Now technological advancements. Now you see this after this digital platforms, you see, even small vendors in our country, you see, they are also, when you have to pay money, they will you see, they will say that you scan. You see, they are also happy because money is straight away going to their account. You see, vegetable sellers, milk sellers, even your e-rickshaw operators, you see, then you see Ola cabs, Ola scooters, all these, they are preferring digital, you see, payments. Money is straight away going to their account, and for the person who has taken the service, it is good for him also. He has not to carry much cash, you see. Now the time has come in our country where, you see, people will do the entire banking with their mobile phone. They will, you see, keep one card, mobile phone, and little money in the, you see, pocket. They need not go to the bank. They will, you see, all banking services by these they will do. Whenever they want to some hard cash, they can withdraw from ATM 24 hours. ATMs are working 24 hours. If they want to transfer money, they can use mobile phone. If they want to pay bills, you see, they can pay by mobile phone. If they want to make any payment, any by means of RTGS, NEFT, by any means, they can do it by, you see, mobile. So there, you see, growth of financial services in India are technological advancements, changing customer expectations, then regulatory reforms, then globalization, and then, you see, innovative products and services. Now challenges, there are challenges also which we are facing, you see, regulatory complexity, and then risk, you see, management, then financial inclusion. You see, although access has improved, a large part of India's population, especially in rural areas, remains outside the formal financial system. Still there are so many people, still they are not having, you see, bank accounts. Though our Prime Minister is doing its best, issuing instructions that everybody in the country should have a, you see, account, but still, you see, we will definitely reach to that stage. Then technology, you see, adoption also. So many people still they don't update themselves in technology. They, you see, are not in a position to, you see, operate, you see, do operations on mobile, etc. Then trust deficit, trust is also not there, you see. Next is talent shortage, you see, talent, that intelligence, you see. Then economic volatility. These are all the challenges where, you see, we are facing. Then now financial services are the life blood of a modern economy. They enable individuals, business and governments to mobilize resources, manage risks, invest productivity and plan for the future. So in this particular, you see, session, we have studied a lot about, you see, financial institutions, mainly commercial banks. We study about a, you see, bank branch, you see, it accepts deposits from the public for giving loans. This is the primary, you see, function of a bank, accepting deposits for the purpose of lending. And in deposits, you see, you can have a savings bank account, you can have a fixed deposit account, then you can have a two-in-one account. In savings bank account, bank is giving, you see, very little rate of interest, 2%, 2.5% to 3%. In fixed deposits, bank is, you see, giving this 7%, 8%, 9%, and you can invest money right from, you see, 7 days to 10 years. Maximum time for which you can make an investment in a bank is 10 years. Beyond 10 years, bank will not invest. Bank will accept money deposit for 10 years, and we have already discussed that banks investment in bank is very safe compared to share market or elsewhere. If any bank goes into loss, Reserve Bank merges that bank with another bank. Your money is very safe. Up to 5 lakh deposits are insured by the Deposit Insurance and Credit Guarantee Corporation. This government office is insuring the depositors' money up to 5 lakhs in one bank. Suppose you are having accounts in 3-4 banks, so each bank is treated separately. Suppose you are having 15 lakhs money, 5 lakhs in each bank, 3 banks you are having, so your deposits are insured. If the bank fails, then your money will be given by Deposit Insurance and Credit Guarantee Corporation, and these money, same money bank gives loans, and bank is giving loans for businesses, housing loan, mortgage loan, vehicle loan, then consumer loan, and credit cards. Bank is issuing credit cards. Bank prefers to issue credit cards who are having salary accounts. Normally they give loans also to them, because everybody who is in job is having a salary account. If a person is in business, he will be doing banking from some commercial bank, so he can utilize the facilities there, like bank gives lockers to his customers also. All the facilities one can have from his bank wherever you are having a account. And in deposits, bank is giving a little lower interest, and in advances bank is charging more rate of interest. The difference is, that is what is bank's profit. And to increase the profit, bank has started now selling third party products also. Bank is selling insurance policies of insurance companies, especially health insurance policies, and life insurance also policies bank is selling. Many banks are having their own insurance companies, like State Bank of India is having State Bank of India life insurance, they are having health insurance also they are having. And those banks which are not having, which have not entered into insurance building, they are selling the insurance policies of other companies, and those companies are giving them commission. Similarly, bank is selling mutual funds of mutual fund companies, and those mutual fund companies are giving them commission. Bank is selling gold coins also, bank is selling, and each bank branch is having about 5,000 branches in our country, each commercial bank. And if suppose one branch sells 5 applications per day of a mutual fund, so 25,000 applications daily that particular bank is selling applications of mutual funds. Now mutual fund company gives 100 rupees commission. You can imagine how much commission bank is earning every day, where no funds are involved. Bank is not parting away with any money. Bank is only selling the mutual fund of that particular company, which is giving him commission in lakhs of rupees. So every year bank is earning lakhs of rupees in this commission by selling third party products of insurance, mutual funds, and gold coins also. Bank is selling gold coins. So we, in this particular session, we concentrated more on commercial banks. Then we discussed about non-banking financial companies also, NBFCs. You can't have a saving bank account in a NBFC. They don't participate in the clearing house. They will be in the business of accepting money, investments. You can invest in a non-banking financial company. They will give you 0.25 interest more than commercial bank, 0.25, 0.5 also they can give. Similarly, there are so many non-banking financial companies, they give you loans. They will give you, like L&T, that financial companies there, they are giving loans for tractors, trucks, etc. they are giving. So they are charging a bit, maybe it's a little more interest than commercial banks, but they are into this business. And then this NBFC, the oldest NBFC is this Muthoot Gold, Muthoot Gold, Manappuram Gold. In no time they will give. The moment you go there, they will see your Aadhaar card, PAN card, gold ornament if you will give. They are having a valuer also there. They will do the valuation of the gold, and they will immediately give you, you see, loan. They mention that we give loan in 5 minutes, 10 minutes we give loan, very fast they process loans, and their loans are very safe. You see, their loans are very safe, because if you don't pay the money, they will sell the gold ornament and close the loan account. Okay students, we are closing the session. Thank you very much students, thank you very much.